Hello and welcome to Tian Finance. Now, this week's market update is especially important because it could be affecting your investments right now, but perhaps not exactly in the way that you might be thinking. You see, most investors believe that if they own a passive offshore global fund or ETF, they're simply buying the market. But one of this week's biggest financial stories actually challenges that assumption. And depending on the fund or ETF you own, you may soon have significant exposure to SpaceX, or you may have no exposure at all. In today's market update, I'll do a quick update on global markets, why falling oil prices and the easing tension in the Middle East really matters for us as investors, a SpaceX blockbuster market debut, and what it means for you as an investor. And then I'll talk a lot about why passive investing may not be as passive as you may think. Now let's start with the numbers this week. What happened in global markets? Well, it was actually a great week for markets. You saw the MSCI All Country World Index up by 2.3%. The JSE All Share Index was up by 1.3%. The S&P 500 was up by 0.65%. And the Rand strengthened against the US dollar from 16.52 to 16.31. And Brent crude also fell by 5% from $91.50 to $86.97 per barrel. So overall, a very positive week for investors. The main driver behind these returns was the falling oil price, which was as a result of some signs or hopes that the tensions between the US, Donald Trump, and Iran may be easing. Now, why is that important? Because lower oil prices reduce concerns regarding long-term future inflation, which in turn increases the likelihood of having lower interest rates. And lower interest rates is good for companies. Now, that combination is generally very supportive for both bonds and equities, helping global markets moving even higher during the week. But let's move now to the biggest story of the week. And the question I want to ask you is, do you own SpaceX? Now, you see, that might not be as simple a question or answer as you might think. Because depending on which passive ETF or fund that you own, the answer could actually be completely different. You see, SpaceX finally made its long-anticipated market debut. The stock was issued at $135 per share, but it opened at $150. At one point, it went as high as $176, and it eventually ended at $161 per share at the end of the first trading day. Now, the enthusiasm was understandable because many investors have waited years for the opportunity to invest in one of the world's most closely watched private companies entering into the environments of space exploration. But behind the spectacular debut of SpaceX lies a much more important story for investors. You see, many investors assume that buying a passive fund or ETF offshore simply means you are buying the market. However, the SpaceX listing highlights how different passive funds or ETFs can end up looking very different from one another. The reason comes down to something known as the free float. Now, when a company lists, not all shares are actually made available to the public to trade or buy. Large insider holdings and restricted shares are excluded, so index providers therefore use a company's free float market capitalization rather than its total market value when determining how big the weighting on a particular index should be. And this is where things become quite interesting because different index providers are treating the exact same company, being SpaceX, very differently. You see, the Nasdaq's fast track rules could see SpaceX added within weeks on their exchange, and because of the company's size, it estimates that it could take up anywhere from 3.2 to 3.5% of the entire Nasdaq 100 index, potentially making it one of the larger holdings in the benchmark almost overnight. Then you have the FTSE Russell, who've adopted also an accelerated inclusion mechanisms that could bring the company into its indices relatively quickly. But then on the other hand, the MSCI is expected to take a much more measured approach, gradually introducing SpaceX through future rebalancing events as additional free float shares become available. And then on the other hand, the S&P 500 follows a much stricter rulebook and may require a longer seasoning period before SpaceX can even be considered for inclusion on their index. So what is the end result for you as an investor? Well, two investors who believe that they own a diversified passive fund or ETF could end up with a completely different exposure to SpaceX. So if you own the Nasdaq tracker, SpaceX could quickly become one of your largest individual holdings. However, if you own the more traditional S&P 500 tracker, you may have little or almost no exposure for quite some time. And that is a fascinating reminder that passive investing is not always as straightforward and as simple as just buying the market. Now, the next big million-dollar question is, should you own SpaceX? Should you go out and go buy some SpaceX shares? And this is quite a controversial question because it seems like there's almost two sides in this camp. There's the Elon Musk supporters that point to the company's great leadership in the commercial space launches, the growth of Starlink, and the possibility that this business could potentially continue expanding for years and decades, specifically in the space exploration area, if Elon were to achieve all of their goals of making space travel commercially viable. Others argue that the expectations for SpaceX are already extremely high and valuations are high, and that even exceptional businesses can disappoint investors if the future growth falls short of what the market expects. The reality is, nobody knows. Nobody knows what's going to happen to SpaceX. What's my view? I think if SpaceX ultimately changes space exploration forever and the share price goes up to like $5,000, there'll be plenty of opportunities along the way that you could buy into if you believe in what Elon Musk and his team is truly trying to achieve. And I think that's perhaps the real lesson for this week's events. Even passive investing involves decisions. The difference is that those decisions are often now being made by index providers rather than portfolio managers. And I think the key is that you need to understand what you own and why you own it. Another area that I'm watching closely this week is the bond market, specifically US Treasury yields, because they remain elevated by historical standards, with the US 10-year Treasury yield finishing this week at 4.48%. Now, for many years, investors were effectively forced into equities because bond yields were exceptionally low. That environment has really changed. Today, investors can actually earn attractive yields from high-quality US government bonds while being paid in hard currency in dollars. Now, for South African investors seeking offshore diversification, income and capital preservation, this is becoming an increasingly compelling opportunity in my opinion. Now, importantly, if inflation continues to moderate and interest rates eventually decline, investors could actually benefit not only from the income earned on these bonds, but also from capital appreciation as bond prices rise. In other words, offshore bonds are once again becoming a genuine asset class, in my opinion, worthy of being considered rather than simply just it being a defensive play to protect. Now, looking ahead to next week, what are the three things that I'll be watching? Firstly, it's the upcoming US Federal Reserve's meeting where investors will be looking for clues on the future path of interest rates. Secondly, ongoing developments around SpaceX and its eventual inclusion into major indices. And then lastly, whether the recent easing in the Middle East tensions continues, and we hope it does. We hope that finally this war gets to an end, and what that may mean for oil prices and inflation expectations. As always, please note this is not financial advice. If you want to get in touch with me, look out for my details in the video, and have a fantastic week onwards and upwards. Bye-bye.